Good afternoon, everyone. John Peitler from Diversified Residential and Commercial Services coming to you. Unfortunately, I was supposed to do a Monday evening training session yesterday, and it didn't happen, but that's okay. I'm excited because what I was doing, I was working last night because one of our new investors that we've gotten on board with has introduced us to the new HEI program, which I'm getting ready to show you what this is all about. So let's get started. Now, there are many different ways clients and customers can access financing for properties, and many are the old conventional programs, government and hard money loans we are used to. There are never any new kinds of programs available, or are there? So let's take a quick stroll to the financial history books. The idea of the mortgage started in England and moved throughout the Western world from 1190 AD onward. In the late 1800s and early 1900s, America's waves of immigrants increased the need for mortgages and affordable properties, with regular money lending dating as far back as biblical records have referenced. First of all, it's important to talk about the meaning of the word mortgage. The word nerds will notice an eerie root word in mortgage, mort, or death, which comes from Old French and Latin. Before that, the letter literally mean death pledge, which is interesting on how this became the word we use probably on our most important investment. Now, don't let that scare you. The debt part of the mortgage doesn't refer to you or any other person. Instead, it refers to the idea that the pledge died once the loan was repaid, and also the idea that the property was dead or forfeit if the loan wasn't repaid. Interesting. Now let's fast forward a bit to the birth of what we recognize today as a modern mortgage. Unfortunately, mortgages at the turn of the century were quite different from today. In the early 1900s, home buyers typically had to pay a 50% down payment with a 5-year amortization period. That meant that those who bought homes or a property typically already had a lot of money. For example, if you were buying a $100,000 home, you would have to pay $50,000 and pay off the remaining $50,000 within 5 years. Increasing the likelihood of default was the fact that the mortgages were structured completely different than today's mortgages. On a 5-year mortgage, home buyers would pay interest-only payments for the 5-year term. At the end of the 5 years, they would face a balloon payment with the entire principal of the loan being due. Now, the system wasn't perfect, but it did provide homes and properties to millions of America. However, once the Great Depression hit, mortgages would never be the same again. During the Great Depression, lenders had no money to lend. And of course, borrowers didn't have any money to pay for the hard-to-find loans either. So here come the roaring 30s. The modern mortgage has only been around really since about the 1930s. Roosevelt's New Deal may have made America what it is today. The New Deal included a number of important regulations that made America a more consumer-friendly nation. The New Deal was designed to stimulate consumer spending and promote economic growth. At the same time, the banking and financial industries would face more scrutiny and regulations. The Federal Housing Administration, FHA, was then created in 1934 and was built to protect lenders and reduce risk, since lenders had become extremely cautious about lending after the Great Depression. This was severely hindering economic growth. The FHA solved this by protecting lenders and substantially reducing risk of borrowers defaulting. Now, to do that, the FHA created a number of variable mortgage services. They created the 30-year mortgage, for example, and reduced the down payment required on a new home. The FHA also created an appraisal system that helped lenders assess the risk of certain properties. This 8-part appraisal system included indicators like protection from adverse influences and relative economic stability. Now, loans that met the FHA standards of approval were known as FHA-insured loans. There were also a number of neighborhoods built across the country known as FHA-insured neighborhoods, which facilitated the mortgage process for new home buyers. Ultimately, the FHA created the modern American mortgage by adding the following. First, quality standards. In order to qualify for an FHA loan, a home had to meet certain quality standards. These standards measured homes' likeliness to hold its value over time. Homes which were more likely to hold their value received the loans. Lower down payment requirements. The FHA started a program that offered 80 to 90% loan to value. Private lenders then had to offer similar rates in order to compete. This successfully lowered down payment requirements. A 15 to 30-year loan. Typical mortgages before the 30s only had a 3 to 5 year period. The FHA began offering 15 up to 30-year loans, stretching out the payments and making it more affordable. Amortization periods. Prior to FHA, mortgages did not have an amortization period. Instead, mortgages involved paying a series of interest-only payments with one large balloon payment at the end of the term, which was the entire principal of the loan. This made defaults a common occurrence and discouraged lending, which is why FHA created the idea of amortization. Amortization involves paying off both interest and principal amounts with each payment. And here comes other major players. Fannie Mae, nicknamed for the Federal National Mortgage Association, was created in 1938 in order to increase the amount of money available to borrowers using mortgage securitization. To do that, Fannie Mae purchased FHA-insured loans and then sold these loans off to financial markets, to investors again. Now, they created the secondary mortgage market and gave lenders a new source of capital. Since loans were packed and sold together, they theoretically carried less risk. Even if a homeowner defaulted, it was unlikely that multiple borrowers in the package would also default. That's not all Fannie did. The organization also mandated fair and efficient lending practices. If lenders did not meet Fannie Mae guidelines, then their loans would not be packaged as securities and sold on the financial markets. Guidelines included interest rate, underwriting practices, and other loan terms and conditions, and suggested lending practices. In the 1930s, Fannie Mae was praised for creating capital in a capital-starved country. And then, to add to the mix, the post-war 1940s and 50s were a booming time for America. Soldiers returning from the war were ready to settle down, buy homes, start families, and become good American consumers. To help veterans returning from the war, the Veterans Administration created a mortgage insurance system of its own. Just like the FHA, the Veterans Administration protected lenders against borrowers' default and insured mortgage loans made by private lenders to veterans. This allowed veterans to purchase homes at affordable rates without a down payment. This was an extremely popular system and surged in demand on the housing and mortgage markets. The economy boomed, and the American mortgage system was praised for being efficient and stable. And then in the 1970s, as baby boomers grew older, their housing demands increased. They wanted to purchase larger and more expensive homes. Unfortunately, the market didn't have quite enough capital to finance the needs of the home buyers. That's where Freddie Mac comes in. In 1970, Congress created an organization called the Federal Home Mortgage Corporation. Today, we know the organization as Freddie Mac. The organization was designed to increase the amount of financial capital available to mortgage lenders and, by extension, of course, to borrowers. To do that, Freddie Mac operated in similar ways to Fannie Mae. The organization purchased mortgages from lenders, giving them more capital to spend on more mortgages. Freddie Mac is also well known for offering 30-year fixed-rate mortgages, giving buyers the opportunity to lock in a mortgage at a lower interest rate in order to hedge their bets against rising interest rates. At the same time, interest rates were rapidly rising. Interest rates rose sharply through the 70s and 80s and eventually rose above 20%. In previous years, lenders were happy to provide mortgages with 20 to 30-year periods, but during this period of exceptionally high interest rates, most mortgages included a 1, 3, or 5-year term. It wasn't until the 1990s that interest rates fell below 7%. In 1972, Fannie Mae and Freddie Mac both began to purchase conventional mortgages that were not guaranteed or insured by the FHA or VA. Instead of seeking approval from FHA or VA, loans could be insured by private mortgage insurance companies. And finally, adjustable rate mortgages, the ARMs, were products of the 80s. Prior to the 1980s, buyers were restricted to fixed-rate mortgages which featured a fixed rate throughout the term of loan. Adjustable rate mortgages were opposite. Interest rates reset over the course of the mortgage. Home buyers may have signed their mortgage when interest rates were 20% and then reaped the benefits of their ARM when rates dropped later. Unfortunately, ARMs also created an opportunity for predatory lenders. ARMs often featured attractive introductory rates designed to entice home buyers into signing up for a mortgage. Then, once that initial low rate interest period was over, home buyers were faced with more difficult higher interest rates and unfortunately often defaulted on their loans. And we remember the 90s. The interest rates of the 80s discouraged people from buying homes. Who could afford to pay for a mortgage with 20% interest rate? The U.S. government decided to increase home ownership to 70%. One of the best ways was to reduce mortgage requirements and encourage subprime lending. During this period, subprime mortgages increased from $35 billion to $125 billion, and millions of people who were not really qualified to buy a home became homeowners. At the same time, Wall Street lenders in the financial industry created attractive mortgage products designed to attract new home buyers. These products included the famous 80-20 loan. Typically, mortgages with a loan-to-value above 80% were required to pay mortgage insurance. To avoid this costly insurance, home buyers could get two mortgages, an 80% first and a 20% second. However, one of the worst and most predatory mortgage products created during that period was the option ARM loan. This loan was an adjustable rate loan which contained multiple repayment options. This loan often featured repayment options where buyers owed more at the end of each month than they did at the beginning. Low monthly payments sounded attractive, but borrowers were eventually stuck with extremely large mortgages they could not afford. Ultimately, these factors achieved the government's goal of increased homeownership across the country. Unfortunately, that increase of homeownership would come at a high price. And the whole ball of wax melts with the Great Recession. The years leading up to the Great Recession of 2008 and 2009 were a great time for mortgage companies. Unfortunately, the good times didn't last forever. The Great Recession was caused by a number of factors, including a U.S. housing bubble, which peaked in July 2006, subprime lending, and of course, a lack of liquidity. The U.S. housing bubble had generally remained stable throughout modern U.S. history before reaching an astronomical high in July of 2006. By late 2006 and 2007, housing prices had declined, and in 2008, the bubble finally burst as home price indexes across the country reported record-breaking price drops. This was seen as being the primary cause of the Great Recession. At the same time, subprime mortgage lenders, fueled by lack of regulation, happily gave out mortgages to virtually anyone who asked. These lenders were accused of using predatory techniques to lure unqualified home buyers into purchasing a mortgage for a home that they could never hope to afford. Many homeowners defaulted on their subprime mortgages. At the same time, the housing bubble had burst, which meant that homeowners were paying for mortgages that were worth far more than the actual value of the home, encouraging them to default. All of these factors combined to create a phenomenon we now know as the Great Recession. The combination of predatory lending, subprime mortgages, and the housing bubble created the worst economic recession of our time. And here we are today, back to the simple core programs we had in the 1930s. However, with more guidelines and regulations than before. And the typical mortgage people get is that 30-year fixed rate amortized loan. So let's understand that for a moment. With a fixed rate mortgage, your monthly payment remains roughly the same during the life of the loan. What changes from month to month and year to year is the portion that your mortgage payment that pays down the principal of the loan and the portion that is pure interest. The gradual repayment of both the original loan and the accumulated interest is what we call amortization. If you look at an amortization schedule for a typical 30-year mortgage, the borrower pays much more interest than principal in the early years of the loan. For example, a $100,000 loan with a 6% interest rate carries a monthly mortgage payment of $599. During the first year of the mortgage payments, roughly $500 each month goes to paying off the interest, and only $99 chips away at the principal. Not until year 18 does the principal payment exceed the interest. The advantage of amortization is you can slowly pay back the interest on the loan, rather than paying one huge balloon payment at the end. The downside of spreading the payments over 30 years is that you end up paying $215,838 for that original $100,000 loan. Also, it takes you longer to build up equity in the home since you pay back so little principal for so long. And equity is the value of your home minus your remaining principal balance. Also, what other downsides are there? Well, if you miss a payment, the bank will notify the credit bureaus, and your credit score will drop. Miss enough, usually between 4 to 6 payments, and you will unfortunately be facing foreclosure and the possible loss of your entire investment. Now, why might you miss those payments? Well, job loss, death in the family, divorce, illness, just to name a few. So the bank initiates foreclosure proceedings. Why? Well, quite simply, the money they gave you in the form of a mortgage is really not their money. It is investors' money that they have given to the bank based on a promised rate of return. In order to give the investor that rate of return, they now have to sell off your home because you have fallen behind on your payments, and penalties and fees quickly eat up any equity you may have had in the property. And enough said. And this is the way we have done home financing in this country. Or is it? What if you, as the borrower, could cut to the quick and deal directly with an investor? A new solution has been created for homeowners who want to unlock their home equity without being locked into a loan. I welcome you to a new way of getting people the financing they need. It's called the HEI, Home Equity Investment. Our lender partner lets clients access $35,000 to $300,000 of their home equity. It's not a loan, so there are no monthly payments. There is no interest charged ever. Instead, our lender partner becomes a partner with the homeowner in the future change in value of their property. If the home's value rises, they share the gains when the client sells or refinances. If the home value drops, they share in the loss. Who is it good for? Many choose the HEI program due to its financial flexibility it provides. This makes a huge difference for people eliminating debt, covering large expenses, or maybe even pursuing an investment opportunity. Others have inconsistent income or use the funds to smooth out a period of unpredicted cash flow. Lastly, the HEI is also a favorite among those who think property markets are at their peak and want to hedge the market. Qualify easier, process faster. We allow you to do everything easily online, and below this presentation is a link to our website so that you can apply. Clients can get pre-approved in minutes and funded in weeks. The eligibility criteria for the HEI are less strict than those for traditional home equity loans. Homeowners with low credit scores or higher debts, people who do not qualify for traditional HELOCs and home equity loans, may qualify for an HEI. Some key points are their monthly payments. First off, the HEI is not a loan, so there are no monthly payments and there is no interest rate. The lender invested in the property with you. So, we do well when you do well. Does the lender share ownership of my home? No, the lender is not added to the title of the property. You continue to own and live in the property and decide when to sell your home. You are the one in control. When do I repay the lender? You can buy back the lender's share at any time prior to the end of the 30-year term. The amount you must pay back, the lender's share, will be calculated using the property's value at the time. But what if my home loses value? If your home depreciates below the risk-adjusted home value, the lender's share in the downside. The risk adjustment reduces exposure to short-term price volatility and makes it possible to offer the lender without an early repayment penalties. Now, lender's share of appreciation. In exchange for lender's investment today, they receive a share in the home appreciation above the risk-adjusted home value. The share is determined during underwriting. Best of all, you can use the money for whatever you want. Renovate that kitchen, open up a new business, pay off high-interest credit cards, or even go on that much-needed vacation. So let's look at some examples of the old way and the new way to get financing. So let's talk about regular conventional 30-year loan at 4% with a home value of $550,000 and a mortgage of $300,000. First, the monthly payments, principal and interest, are $1,432.25. The homeowner owns the home for 10 years and then decides to sell. After the 10-year, the principal that is owed on the loan is $233,047.35. The principal and interest payments to date are $171,870, so the total paid back to the bank after 10 years is $404,917.35. The new way, $300,000 is taken. After a 10-year, the new appreciated value of the property from $550,000 is $731,396.65. The investor takes their loan back, the $300,000, and 22.3% of appreciation above the $550,000. So we now have $300,000 plus 131,396.65 times 22.3%, or 300,000 plus 29,301.45 equals 329,301.45, or a savings of 75,655.90, and some other benefits. There is no risk of foreclosure. This is a win-win for all. This is a good program that can satisfy the needs of potentially thousands of clients. But like anything new, it will be hard to accept. Oh, it's a scam. It's not true. I won't qualify. Which is why you need to check it out at the link on the bottom of the page. So check it out. See if you can qualify. See if it's really for you. And if it is, great, fantastic. So thank you very much for watching the presentation, and have a great day.